Okay, so let's begin with the ninth reading, Learning from Financial Disasters. It's a very important reading because we need to learn from the mistakes of the organizations in the past and not repeat them in the future. The first case study that is given is of the savings and loan industry in the 1980s. So let's understand the first point. Firstly, banks obviously charge a spread. That is, if you deposit in the bank, they'll give you 3%, and if you take a loan, the banks will charge you 5%. So banks earn that 2% spread, for example. Also, the second point, moving to the second point, banks will give you a higher interest if you invest for a longer term because that money stays fixed in and the bank can invest that money for a longer term. Also, if you take a longer term loan, bank will charge you a higher interest because the risk is higher. What if you die? What if your organization fails during that time? So if let's say the short term 1 year deposit rate will be 3%, the loan borrowing rate will be 5%, and for 10 years, the deposit rate will be, let's say, 4%, and the borrowing rate will be 6%. So there's a 2% spread this way and 1% spread in maturity. Okay, so now what happened was that banks, let's draw this graph over here for interest rate versus maturity. So if I deposit, if I borrow for the short term, the bank will charge me 5%, and if I borrow for the long term, bank will charge me 6%. So the plot looks somewhat like this, rising interest rates with maturity. So what happened was that the banks, they were accepting short-term deposits. The banks were taking short-term loans, uh, accepting short-term deposits, which they had to pay 3%, and the banks were giving out long-term loans at 6%. So instead of the 2%, now the banks are earning a spread of 3%. And this extra 1% or 2% or whatever the spread would be, this greed caused huge losses to the banks because after a point of time, what happened was that the Fed raised interest rates. And what that did was it made this 3% into 5% and this 5% into 7%. So now the bank is getting deposits at 5% or even more, and the bank uh, is earning 6%. And if it increases even further, which happened really, that the bank was accepting deposits at over 6%, 6 and above, and the bank had to pay this 6 and above, and the bank was earning only 6%. And ultimately, the banks faced losses due to what is called, this is called a maturity mismatch. And this is the crux of a lot of crises that happen, that people or organizations, they accept short-term deposits and they invest in long-term assets, like I had explained earlier as well in liquidity crisis in the first reading itself. And I have written the same thing over here on the side with some terms. So this is called riding the curve. When you accept deposits for the short term and you invest for the long term, it's called riding the curve. Now we move on to the second case of liquidity risk, which primarily, the crisis in this aspect primarily stems from funding liquidity risk. Like I have explained over here, banks accept overnight repo rate. Uh, Banks take deposits using overnight repos, that is overnight loans at very cheap rates, let's say 2%, and banks invest in long term, let's say 30-year assets at 6%, and they imagine that this funding will continue forever, but it does not. And the value of this assets that the banks were investing in, like Lehman Brothers given here, they were subprime, that is full of shit, you may call that. And this ultimately led to the demise of Lehman Brothers in 2008, September of 2008. Similarly, for continental Illinois, what happened was that there was another bank, small bank called Penn Square Bank, and there was a large bank called Continental Illinois. So Penn Square Bank would transfer all of their larger size loans to their partner Continental Illinois. And Penn Square Bank dealt in a few energy derivatives and in the end give loans to players in the energy markets. And when the energy market fell immensely, uh, again the Penn Square Bank faced losses and it got completely wiped out. And again, Continental Illinois faced losses because it was accepting short-term deposits and investing in the long-term assets of the loans. And when the long-term assets started falling, this overnight repo stopped rolling over there was no overnight repo, but I'm using the term as a continuation. It was another form of short-term funding. And also, what happened was that since it was a bank, a retail bank, depositors came and they withdrew most of their money. It's given here. Almost 20% of the bank's deposits were withdrawn. This is called a run on the banks, that people ran to the bank and they deposit the money in the fear that the bank will crash. And this compounds the crash even further because the bank is losing deposits when it needs it the most. The third one, given under liquidity crisis, Northern Rock. Again, it is almost the exactly same thing as Lehman Brothers, just that this bank was in the UK. There's nothing much for me to explain. It's the same thing as Lehman Brothers in the UK. Now, we learn a few lessons from these liquidity linked crises is that there should be an asset liability management committee or asset liability manager so that they can prevent this mismatch that we see. A manager can prevent this mismatch from happening regularly, and it can prevent the demise of the banks such as Northern Rock and Lehman Brothers. The second point we see is that low duration of liabilities, that is, this low duration of liabilities reduces the interest rate risk, because now if the interest rate falls in the market, then you can deposit the depositors, you can pay the depositor lesser, but if interest rate rises, there is still a risk, and there is also a rollover risk. The next point that we see, and the last one over here, very important, that there must be emergency credit access and credit lines accessed. So what happens is that every bank has emergency access with another bank. So for example, if I'm in a crisis, I will go to that bank and withdraw some money, and this is already fixed, and I'm already paying a very small amount of interest on that money for a long time, and this is very regulated, and I have to do this. Most big banks, the GSIBs and SIFIs, they all have to have credit lines open so that in a crisis they can withdraw money. And if the entire industry is doing bad as a whole, then the Fed will intervene and they will give credit lines to these banks. The third and most interesting one that we come to is hedging strategies. So now you'll understand what static and dynamic hedging are. And now we'll see how one such hedging strategy caused huge losses to a company, a refining company called Metal Cell Shaft Refining and Marketing. So they, let's say they have they were selling gas to consumers, and what they did was they made a contract with the consumers that they will sell the consumers oil at a fixed price over the next 5 or 10 years. So they did a long term, it was long term for 5 or 10 years forward contract with the consumers, and it was a short contract because they were going to sell. So long term forward contract, short, and they did the entire five. They estimated the entire 5 years worth of gas requirement, and they made that contract with their consumers on the entire amount. Now to hedge this exposure. So now what if the prices start rising in the market? To hedge that exposure, they uh, have to take short term, they had to take futures contracts because such long term futures contracts were not available, so they had to enter short term monthly futures contracts, and they were short term future, and they were long since they bought those contracts to offset it. Short and long, they thought they'll offset it, but the problem was that one is long term, one is short term, one is forward, one is future, and all these four terms together caused the crisis, and we'll see how. So what they did was, let's say the entire 5 years worth of requirement, let's say 100 million barrels. They have taken a long term forward contract that, okay, let's say 60 million barrels for 5 years. So I'll supply you 1 million barrels every year, 1 barrel every year, every month, 1 million barrels every month to the consumers in total. And this monthly contract that they are entering into the futures contract, they now, what happens is at the initiation of the contract, say in, if you draw a timeline at point 0, they enter 60 forward short, 60 forward long, future long, cancelled off. Now next month they have supplied So now the forward contract has become 59. So now this futures contract, which they were long on, they roll over only 59 of these. Okay, now you're understanding what I'm saying? They roll over only 59. They don't roll over one contract because that has already been supplied and that does not need to be hedged. This is how stack and roll hedge works. They stack 60 contracts together and they roll over one less every month. There was no problem as long as prices were rising in this case, because if the prices are rising, you are incurring a loss in your forward contracts now. Since you're short, you will incur a loss when price rises, and you will incur gain a profit when prices rises from your long contract. So it gets cancelled off. But the problem arises when the prices start falling. What happens is that when your prices are falling, you gain from your forward contract and you lose from your futures contract. But the forward contract is only settled at maturity. That is, at the end of 5 years or so, the forward contract will be settled that these gains will be realized at the end of 5 years. Not right now, but these losses, which are huge, huge losses, will have to be paid right now. There will be margin calls, and the problem compounded because this entire 5 years worth of requirement was hedged monthly. So now, let's say all the other players in the market, when they are hedging their exposures together, their monthly requirement, or let's say their daily volume in the market, was about 15 million barrels. And when this crisis struck, metal cell shaft, they had 55 million barrel contracts remaining. So it was very difficult to unwind their positions in that short frame of time frame, since their positions were so huge compared to the volume in the market. And this difference between forwards and futures and short term and long term led to the demise of metal cell shaft. Now people argue that this strategy was good, this strategy was okay, but I don't think it is good, because prices can fall, and usually people die when, not people die as in portfolios get diminished when prices fall, not when prices rise. And this difference between the forward and future ultimately led to huge losses for the company. This entire thing has been explained with some extra points here and there. You should read through it. Nothing else over here. So next we move on to model risk. So model risk, people develop some models. Okay, banks, organizations, they develop some models, but there can be wrong inputs to the data. People can tweak the models according to their requirement. There might be incomplete data, some wrong estimations, etc. So we'll see how those impacted organizations in the past. The first is Niederhoff case. So for that, let's understand what he did. The first thing that he did was he was selling put options. Now, what are put options? Let's say the S&P 500 is at $1,000. S&P 500 is here. He will go and tell you that if the S&P 500 falls below 950, I will give you whatever amount that is. Let's say if it falls to 900, I'll give you 50. Okay. And in those days, his model told him that this 5% decline was very, very unlikely. So he was happily entering into this contract. And why was he entering into this contract? Because for this contract, he was getting a very small amount, let's say $0.5. He was getting $0.5 on one contract, one such contract. That is, I give you $0.5, and whenever the price goes below 950, you will have to pay me the difference. All right, simple as that. And he assumed that the price will not fall below 5%. And in 1997, the Asian crisis spilled over into the US markets, and S&P 500 fell by 7%, which was below his 950. And by then he had huge positions in millions, and it led to him facing losses of over 50 million, and it wiped him out completely. The next model risk was of long-term capital management. They were one of the very large hedge funds, and their strategy was a relative value play. First, let me explain their strategy. What does relative value play means? So they thought that their model told them that there were pricing discrepancies between two assets. Okay, so they short one and they long one, and they try to earn an arbitrage profit. So let's say they short German bonds and they went long on Italian or Spain bonds. or corporate bonds, whatever. So what this does is Germany, let's say, is a more developed country, you can say, and more stable. So it will. So since they go short, let's say they'll have to pay 2%, and Italy and Spain are a little more emerging than, little less developed than Germany. So they will have more risk. So they will give more returns. That is, let's say 3%. So they earn that 1% and some pricing discrepancies as well. The same thing they did with US and Russia. Okay, they short US bonds and went long on Russian bonds. But what happened was that in 1998, the Russian government defaulted on their bonds. And long-term capital management's model failed to consider increase in correlations. They considered correlation, but they failed to consider increase in correlations because we usually see that US and Russia are considered to be opposite parties. That is, they are considered to be polar opposites to each other in many aspects. So, if Russia defaults, the value of the Russian bond falls, obviously goes down to almost zero, and they are long on the Russian bonds, so it goes down to zero. So now there will be a flight to safety. That is, people will go and buy US bonds more, seeing that Russia has defaulted. So the US bonds on which they have gone short, the price of that increase, and again, even more losses. And now these losses were even more compounded because LTCM had a leverage ratio of 26 is to 1, 26 times. So let's say you have an asset of, let's say you have $100 with you and you bought something worth $2,600 using that. So this huge leverage combined with this increase in correlation, which was not estimated by the model, led to uh, huge losses for LTCM until the Fed intervened and saved them. Now we learn a few lessons from LTCM, like you need to monitor correlations and changes in correlations. You need to watch your liquidity and have some credit lines, backup credit lines. Then you need to consider loss assumptions. So another thing that happened was that since LTCM was such a huge hedge fund, the they couldn't liquidate their positions in in a short duration because they were already leveraged and they were very huge organizations, and people did not imagine that they would face such losses, so they did not even ask them for margins. So that would have led to a systemic failure until the Fed intervened. So the next one is the London whale trade case. This basically says, I'll sum this one up quickly. It says that there was a CIO, a chief investment officer of JP Morgan, in the London office, and he was given some extra funds that was lying, and using those, he entered into some very uh, complex derivative transactions using structured products. And later on, when the bank told him that he needs to reduce his risk exposure, he did not do so. In turn, he took opposite positions. That is, if he was long on one asset, he went short on the other on another asset, and he said that look, the exposures have been netted off, but in reality, they had not been netted off, and this ultimately led to huge a huge risk exposure for JP Morgan. And also, what happened was that whenever there was a risk breach, he would tweak the risk modeling system to show that in some way that the risk is actually lower. For example, during the day, let's say a model tells you that at 9 o'clock your risk is 10 million, at 9:30 it's 30 million, at 10 o'clock it's 5 million, and it increases or decreases after that. So he only reports that 10 a.m. figure of 5 million rather than reporting the highest 30 million or even more figure of that. So that is how he gamed the model, and ultimately the bank realized this error, and the losses were too huge for the bank. A 6.2 billion in losses because of one person. So the fifth one that we come to is rogue trading. This is important, and I've mentioned Nick Leeson and Barings Bank before as well. So he was a rogue trader. That is, originally he was on the bank's desk to trade with the client's money, but he was also assigned with clearing his trades. Like he was his own supervisor, so to say, and he was managing the trades and entering them in the trade book because back then this was done very manually. It was not as automated as it is now. So what he did was he used the bank's money itself to enter into trading positions by creating a fictitious account. And ultimately, when he started incurring losses in these positions, he, rather than closing this account down and reporting it to his managers, he doubled down on these positions and incurred even further losses. But these, he was reporting these losses as profits in turn in the books, and the managers were his management was the management of Barings Bank was very happy, and everyone was getting good bonuses, and they were not questioning him, but the risk management team was in fact questioning him. Some people were, but he did not pay heed to their concerns. The management did not pay heed to their concerns, and ultimately, a 200-year-old bank faced 200 million in losses because of one 200 million pounds in losses because of one person, and ultimately it closed down. So next we see financial engineering. So there are a number of new products that have come up, and non-financial companies are trying to use these products to gain some profits, and they do not understand the complexities and the risks involved in these products. So let's see the first one with Bankers Trust. So Procter and Gamble had businesses in US as well as in Germany, and what happened was that they wanted to hedge their interest risk exposure. So they went to a skilled risk manager at Bankers Trust, and they developed a system wherein uh, Bankers Trust would give PNG a fixed amount like a swap. So the Bankers Trust would, let's say, give PNG fixed amount of 2% BT to PNG, and PNG would give them a floating rate of anything linked with, let's say, Libor. For now, London Interbank offered rate. Let's say PNG would give them the Libor rate. So the problem arises was that PNG was trying to hedge its a fall in this fall in the interest rates, but the Fed raised interest rates by 250 basis points, that is 2.5%. So PNG had to pay a very high amount, but it would still have been okay. But what Bankers Trust, the manager at Bankers Trust did, he created a very leveraged, complex leveraged product which PNG did not understand, and the actual value of their losses was much, much, much higher than what they had expected. So ultimately, PNG sued BT for creating such a product that the true nature, the true risk of which was very disguised, so to say. And ultimately PNG won the suit, and there was a huge reputational damage for Bankers Trust, and ultimately they closed down. The second and similar case was for Orange County. It was a county in California. It is a county in California, and the treasurer, again, he entered into some complex derivative transactions, swap transactions, in the view of earning a profit. So what he did was that, like I've written over here, Orange County, they borrowed money from the market at repo, overnight repo. They gave them the fixed interest, and they invested these in inverse floater assets. So what are inverse floater? You pay a fixed amount and you get, let's say, you pay fixed interest and you receive, let's say, 8 minus the Libor rate. So if you're getting 8 minus the Libor rate, so you will want the Libor rate to fall, obviously. But what if the Libor rate rises? And that is exactly what happened. Again, a 250 basis point increase. It was, I think it was around the similar time. Yeah, it was in 1994, both of these cases, BT and Orange County both. Libor rates increased by 200, Fed increased rates by 250 basis points. So Libor rate increased, and Orange County faced huge losses. The third one is Succin London's Bank. Similar to Lehman Brothers and Northern Rock, they invested in securitized subprime mortgages, which were highly leveraged and subprime, and ultimately they failed. Simple, nothing much to explain in this one. Next one is reputation risk. So the public perception of fairness and commitment to ethical behavior is very important nowadays as well. And one of the very most recent violators of this was Volkswagen, wherein they gamed their system and said that our cars are very fuel efficient and they are not impacting the environment. But they gamed their software and showed that our cars are very good. But almost 10 million cars between 2009 and 15 were affected by this software, and they were actually impacting the environment more harshly than the software had predicted or the software had estimated. So ultimately, Volkswagen faced a huge reputational loss, as well as they had to pay fines in billions and billions. Next, eighth point is corporate governance. We've already done a reading on that, and wherein I talked about Enron as well. So let's see what happened with Enron. Basically, it was a complicated accounting failure, wherein the management put their self-interest, their short-term goals above the interest of the firm. The CFO tried to transfer funds to his own firm. The auditors, there was accounting fraud. The auditors were window dressing the books of accounts. All of that combined led to the demise of one of the largest energy companies. The ninth and last one is cyber risk. So in this technological world, there is a huge cyber risk nowadays. Your computer can be hacked at any time. You need to keep it safe. You need to keep your data safe. Anyone can hack your we bank account. Anyone can withdraw your money nowadays, and we've seen these cases happening. There are some OTP frauds also recently. So now, one example of this was of Swift. So Swift is basically a electronic transfer system. So if you have to send money from here to the UK, for example, to pay a fees, so your bank does it using the Swift system. And what happened was that the Bangladesh bank had their deposit in a New York bank, and someone got access of a Bangladesh bank employee, and they used their access and credentials to transfer 81 million from the New York bank to some banks in Asia, where they withdrew the currency immediately, and they were never found. But the New York bank detected this error, so the criminals, so to say, were originally planning to withdraw 1 billion, but they stopped at the transaction was stopped at 81 million because the bankers in New York, they noticed a lot of errors in the requests, and they realized that something was wrong, because usually I think bankers would not make a lot of easy spelling errors, and ultimately they were never caught, but the money trail was not found, and it was last tracked to some casinos in the Philippines. But it was a very sophisticated cyber attack, and these cyber attacks happened recently as well, and we need to keep our system secure. That was the reading.